Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, China's electric vehicle industry is threatening to dominate the market. Can U.S. automakers step up and pull ahead of the competition? And later, a big week for artificial intelligence. NVIDIA's blowout earnings show how companies are leveraging technology, but are investors setting themselves up for a big disappointment? But we begin with our expert panel and three things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Ben Levison, Jack Howe, and Teresa Rivas. So Ben, we all think last week was scary. There was a bad drop in the market on Thursday, but when you looked at the end result, the S&P and NASDAQ were up, Dow was down a little bit.
Yeah, I mean, if you looked at the market, the Dow, it was a terrible week. The Dow was down more than 2%. But then you look at the NASDAQ, it was up more than 1%. And the S&P, it almost did absolutely nothing. It would have been the most boring week possible. And there were lots of reasons being thrown around, whether it was the Fed minutes and rate hike fears and all that kind of stuff. But really, it just comes down to NVIDIA. The big chip maker came out with earnings, jumped something like almost 10%. And whether you owned NVIDIA or not really determined whether the index went up or not. NASDAQ owns lots of NVIDIA. S&P owns still a good chunk of it, but not as much as NASDAQ. And the Dow owns none. It only owns Intel. And that really determined which index was up and which one was down.
You wouldn't suggest that investors run out and load back up the truck for NVIDIA, though, right? I mean, most of us actually own NVIDIA through an S&P 500 fund or an actively managed mutual fund.
That's right. I mean, if you own an index fund, an S&P 500 index fund, you have a 5.8 percentage point stake in the stock. It's the third largest holding in the SPY ETF that follows the S&P 500. So you really don't need to go, buy another chunk of this unless you really think NVIDIA is going to keep going up. But I just think getting that kind of concentration in any one stock, you already got enough in the S&P 500.
That makes sense. So we've got a long weekend. Coming out of the long weekend, a few earnings reports will trickle out, but really, I guess inflation will be on everyone's mind.
That's right. I mean, we're going to get things like Costco. We'll get Salesforce.com, but they're not going to really move the market. What will is PCE. That's going to get released. It contains the Fed's favored inflation metric. The core PCE is supposed to, price index supposed to rise about 2.8%. That would be the same as last month. We really need to see that start moving down. If there's a surprise higher, it's going to be bad news for this market.
Alrighty, let's move to Teresa. A tale of two retailers. The week before last, we saw Walmart come out with great earnings, and they projected good things ahead. Target came out this past week, not so much.
It pains me to say this as someone who is Target all the way, but it honestly feels like Walmart is the new Target and vice versa. If you're thinking of a pleasant shopping experience in a well-stocked, bright store, you used to think Target, whereas the new Walmart supercenters look like that. And Target are the stores that are kind of dingy, not well-staffed, running out of stock. It's unfortunate, but I feel like that is really playing out. And you see that in the earnings. There's the question of closing self-checkouts to reduce shoplifting. Target's been successful there, but at what cost? I personally have walked out of the store without buying things because I don't want to wait for the 2 cash registers that are open.
So I'm not sure what the Frankification of Walmart is, but it sounds as if the whole store experience is becoming more Target-like, and they're doing other things very well too, right?
Certainly. I think we've seen them increase the range. You see a lot of high-income Americans shopping there now, and Walmart makes that easy with something like Walmart Plus. That's their subscription service. And they're doing a lot of other things right, too, in terms of branching out into advertising and other high-margin businesses.
Yeah, it's really interesting. They have so many people coming to their website, they can actually sell advertising against that.
Exactly. All those eyeballs are really valuable the same way they're valuable on something like Amazon.
Sure. All righty. Jack, you flew back from Houston, where you experienced a terrible storm, just in time to experience a terrible storm up here. What's the market connection to that?
It's getting nuts. Well, we're coming up on the start of the Atlantic hurricane season. That's June 1st. It runs through November. NOAA, that's the weather science group, they say it's going to be a double doozy. It's the highest probability ever of a bad storm season that they're predicting. And it's also, they're predicting the greatest number ever of named storms. We could get all the way from Alberto through William this season. And you should say a prayer for your homeowner's insurance because costs there are soaring and companies are getting choosier about their coverage. In Houston, freak storm, 100-mile-an-hour winds knocked out power for 1 million people. One woman that I spoke with said her roof was damaged. She's not sure how she's going to pay for it because she wasn't able to get coverage from a private insurer. She had to use state coverage, which she said is not very good. That's becoming common around the country. I come back to Westchester, New York, where I live. Freak hailstorm took down branches all over my town. Nothing on the scale of Houston, of course, but a lot of people are wondering, is the wacky weather coming for them next? And financially, it might be, because there were 18 states that ran losses last year in the homeowners insurance business. And so, as I say, that's causing companies to raise their prices and to get picky about what they'll cover.
Yeah, it's really difficult for homeowners. I'm wondering, though, what does it mean for the insurance industry? Are they going to be able to raise premiums enough to cover the potential losses?
So the way it usually works is, you get this base level of storms each year. You get one really bad year. The insurance companies run a loss. Everybody raises prices. And then investors actually turn bullish on the stocks because they figure, okay, the prices are going to stick, the higher rates are going to stick, and we're going to go back to normal on the level of damage. And we've actually seen some of these stocks running up lately. The problem is, if Noah's right about the coming hurricane season, if that's real bad, and if we do see this higher base level of storm damage, the biggest increase in storm damage in damage around the country hasn't been from hurricanes, it hasn't been from wildfires, it's just been from severe storms that aren't hurricanes. So if we see this higher base level of damage going forward, it might not be so profitable for insurers. We might see a continuation of rate hikes.
And there's still some nice communities on the East Coast toward the north that are very vulnerable. I mean, if a hurricane of 38 comes through again, that's going to be ugly all around. Thank you, Jack. All right, the investing landscape has entered a new regime, according to my next guest, and she's out with a playbook on how to reassess your portfolio for success. Global wealth strategist Paula Campbell-Roberts joins me next. Higher interest rates, persistent inflation, rising geopolitical tensions, and an election year are all playing a role in how investors should allocate their money. My guest is out with an investment playbook to help us navigate these markets. Joining me now, KKR Chief Investment Strategist for Global Wealth, Paula Campbell-Roberts. Paula, thanks so much for coming in.
Thanks for having me, Jack. It's a pleasure.
So you are firmly in this higher for longer camp, but some of the forces that convince you that that's the case might surprise some people. Let's start with AI. So everyone says AI is going to make us more efficient, maybe replace some labor. Those are disinflationary forces, but you say in the short term, at least, AI could be inflationary.
That's exactly right. The belief is that AI would pull the steam out of the inflationary environment we're experiencing. But in reality, if you think about the infrastructure required to support AI, from water usage to the use of energy and even labor, which is in short supply today, because of those are in short supply, that will drive up inflation in the short term.
Another trend you're looking at is immigration and demography, and you think the demographics could be inflationary as well.
That's exactly right. For a while, we've been talking about the aging demographic, right? The aging of the population.
And they're supposed to spend less, right?
Exactly. But now, fast forward to COVID, when you also had excess retirement. The resulting labor shortage is what is driving wage inflation higher, which is supporting the elevated level of services inflation. So, too, demographics are inflationary.
All right. So let's talk about the investment playbook in this scenario. You focus on private markets, but real quick, if you were restricted to public markets, what would your advice be?
Absolutely. So if you think about what's going on in large cap public equities in particular, both in the U.S. and in Europe, they're both suffering from a concentration risk. That is 7 to 11 stocks, depending on the region, are really driving the performance in both indices in the U.S. and in Europe. That's a problem if you think about what most 60-40 or balanced investors believe that they're invested in. So what's critical for investors in public markets is to seek diversification. So if you're a U.S. investor and most of your portfolio is in U.S. equities, I would say seek regional diversification. Europe looks attractive, but also Japan, for example.
Yeah, Japan's been doing very well. And to your point, like you own the S&P 500, but it's mostly 10 stocks.
Exactly.
Okay.
It's in 7.
So that said, people probably don't understand that most of the economy is not the S&P 500. It's actually private companies. That's where you play. And we've actually seen a trend toward fewer companies going public. The Wilshire 5000 only has about 3,000 stocks in it. At the risk of talking your book, tell us why you like private markets.
Well, to start with, if you talk about the opportunity set, since 2012, the number of public companies in the U.S. has been shrinking by 30%. Globally, that number is maybe closer to 50%. So if you're just an investor and, again, seeking diversification, why would you limit yourself and only limit yourself to a smaller opportunity set? So first and foremost, invest in private markets because that's where the bulk of the opportunity set lies.
Alrighty. Now, you're going to be careful about, I know, talking your book, but I'll talk your book for you, which is to say there was just this announcement, it was reported in the Wall Street Journal late last week, that KKR was partnering with a retail-focused mutual fund company, Capital Group, to come out with these ETFs, these hybrid ETFs that will be partly publicly traded bonds, but also private companies. So can you go into a little more detail for us about what you think the benefits to adding them to your 401k or your investment thesis would be?
So private markets will help investors achieve some of that diversification, volatility mitigation, and even help investors boost returns. That's critical in terms of the value proposition. Now, when we think about private markets, institutions have relied on private markets for decades, but until recently, only ultra-high net worth individuals could access those very same investments via drawdown vehicles, for example. More recently, evergreen products are now available to accredited investors. But with this new announcement that you've mentioned via Capital Group, and I think this is the direction that the industry is headed in, now you have non-accredited investors having access to these very same investment solutions.
Unfortunately, we don't have time to do a deep dive into illiquidity risk, but another benefit here can be that because it's not sold as frequently, there's a little less pressure in bad times to just dump, right?
That's absolutely the case. That's part of the reason you have this illiquidity premium, right, which is the excess return of private markets over public markets. And in private equity alone, that has over time averaged around 4%. And in times of dislocation, that percentage has actually increased. And in the market, we foresee over the next 5 years, driven by the very same factors you started out describing, volatility is the thing we expect. So this is a time where private markets and private equity should outperform.
As long as people can be careful about those fees. I'll say that, you won't. Paula Campbell-Roberts, thank you so much for coming on the show.
Thank you, Jack.
China's electric vehicle success is driving concerns here at home. Our expert panel looks at how U.S. automakers can pull ahead next. From clothes to toys to electronics, the Made in China label has flooded the U.S. market. Could the auto industry be next? The Biden administration has announced a 100% tariff on electric vehicles imported from Beijing this week, trying to protect American manufacturers. Former President Trump says he'd raise tariffs even higher. But the threat might be overblown if U.S. automakers step up their game. It's the Barron's cover story this week, and associate editor Al Root joins the panel. Al, great story. I learned a lot of stuff. Let's start with, I really did. The Alliance for American Manufacturers says Chinese EVs, quote, could end up being an extinction level event for U.S. automakers. What's driving all this concern?
Yeah, I don't know why I should be surprised you liked it, but that always surprises me. Listen, a $10,000 car, it just isn't the threat that you think it is. Now, BYD is a real competitor. There's lots of things that are reasons people are afraid. China's the largest market for new cars now. It's the largest maker of electric vehicles. BYD made 3 million electrified cars last year. In the fourth quarter, they actually sold more cars, all electric cars, than Tesla. So there's lots of reasons that you should be afraid. But we can get to the $10,000 car in a second. There's no Chinese branded car sold in America right now. There's no Chinese capacity on this continent except a small joint venture plant in Mexico. The Chinese will export cars. They're going to start in Europe, and they also ship cars to Southeast Asia and places like that. The threat for the U.S. is literally a decade away, and that makes these tariffs to some extent politically motivated, and you can even see that in this sort of back and forth of I can raise tariffs higher than you.
All right. So we saw the yellow car. That's called the Seagull. You said it looks like a minion from behind. I'm not rushing to the dealership for one of those, but I could see a recent grad, a $10,000 electric vehicle. Hey, that sounds like a good deal.
Yeah, and it's not that nobody likes a good deal, and it's not that. But the thing about the Seagull, it's just not magic. General Motors can make cheap cars too. They have a $5,000 EV in China. The market sort of decides the kind of cars that you purchase. And, those college students, the cheapest 10 cars in the U.S., they garnered about 6% of the market in 2023. That's the market for the cheapest cars. And then the kind of market that you're in, whether it's China or India, Mexico or here, that sort of sets the price of the cheapest cars. You're not going to run out and buy the Seagull because Americans tend not to want stripped down cheap cars. It is always a nice headline. We use the Yugo analogy in the story. It was a $4,000 car, and it seems great, but then service is a problem, reliability is a problem. It's actually very expensive to get it fixed. Remember, the upfront cost is only one portion of the equation there.
So what do you think U.S. automakers need to do to head off this Chinese competition?
So the way I liked it best, we were chatting with the president of Volkswagen America, Pablo Deci, and he was sort of pragmatic, and he's a foreign automaker with capacity in the U.S. He said, listen, these tariffs can't last forever. It gives you sort of 10 years to get your act together. So what do you have to do? You have to, when Ford and General Motors faced the threat from the Japanese over the last 40 years, they were sort of content to just sell SUVs and trucks and cede all the rest of the market for smaller cars to imports. Not exactly the best strategy. You have to build a full lineup of attractive cars, and you have to defend market share. You have to compete. You have to sort of strategically say, all right, what am I going to do? For Ford, I think they should be very careful to protect smaller truck share. General Motors is introducing cheaper EVs this year. They should continue to do things like that. They should not do what they did. And the thing about electric vehicles, batteries are about 2 times the price of labor in a car, right? So labor costs in China have been an issue. The battery, having low-cost batteries can become a defining competitive advantage. So it gives you a chance to make a better car without just throwing up your hands and saying, I can't compete with Chinese labor.
I thought you were going to say a lot of cup holders and wide seats for big American backsides. But which U.S. auto company would you say is the most at risk right now?
Clearly, it's Tesla. And, if you go back to that, the Japanese... Tesla is the General Motors of electric vehicles. It has about 50% market share in the U.S. When General Motors first saw those Toyota cars coming into their market, they had about 50% market share. So Tesla has the most to lose. It's clear as day. And they need to do the same thing, right? They basically have 2 popular models, the 3 and the Y. And they basically said, we're selling so many cars, I don't need a small car. And then BYD comes along, growth collapses for Tesla, and now they're trying to accelerate their small car. They need a full product lineup that people want.
And we should say briefly that while China could slap tariffs on Tesla, they're a little bit less vulnerable because they actually built things in China.
Yeah, it's more about general business climate for American businesses in China. And, Americans and Chinese aren't getting along so well. So that's the risk.
That is true. Thanks, Al. Teresa and Ben, meanwhile, have a pair of investment ideas. And Jack's going to explain to us that while the AI boom sends NVIDIA soaring, it could mean trouble for Google. Stay right there. So, Jack, when it comes to AI, everybody's talking NVIDIA's earnings or Scarlett Johansson. But in our business, the news business is not so pretty. If somebody searches for information, instead of getting a link to Barron's, they get a paragraph from Google explaining it. You say that's not good for Google either.
AI could be the biggest threat to Google in decades because it gives you the answers. It doesn't send you clicking around the internet. I asked Google just before the show, how do I appear slimmer on television? This is for a friend. It's not for me. Google gives me links to articles, right? It gets paid mostly through advertising, paid links, purchases, and the publishing industry, as you say, depends on that traffic. If I type the same thing in at Perplexity.ai, that's a startup competitor to Google, you don't get links. You get these neatly formatted tips. Wear monochromatic suits. Sit up straight. Invest in good shapewear. I don't know what if the future of search involves less clicking, it's unclear what that means for Google's advertising profits. That is a subject of my Streetwise column in Barron's this week. If I had asked artificial intelligence Ben, he would have just said eat less. But, he's a humanoid with a very advanced algorithm.
I didn't realize AI was going to be good for Spanx for men. So that's an interesting discovery as well. Thanks for doing that, Jack. All right, let's move to actionable ideas. I will start with you, Teresa. You were bullish on TJX a little over a year ago. Turned out to be a good call, and you're sticking with it.
That's true. Everyone's going to be buying their Spanx there. So TJX just reported another strong quarter. They own Marshall's, TJ Maxx, Home Goods, those kind of brands. And off-price discounters have been taking share in the retail industry for ages, and it doesn't look like that's slowing down anytime soon. TJ Maxx is the leader there, and they'll continue to reap the benefits.
Alrighty. And Ben, you are sticking with the retail theme.
I am. I mean, we all love the mall, right? Or at least we did before, 2020. But the malls, actually, some malls are doing okay. These are the high-end malls. And you get a company like Simon Property Group that has some very high-end malls. It's doing great, but the stock hasn't done anything since about mid-December. It recently sold, it owned some retail brands. It sold a stake that it had in that. And the stock is 30% cheaper than the REIT index. And so it looks like that this is actually a pretty decent time to pick it up. It looks like it could break out to the upside.
Alrighty. Thanks, Ben. Thanks, Teresa. Thank you, Jack, as always. To read more, check out this week's edition at barrons.com. And that's all for us. We'll see you next week on Barron's Roundtable.